Hello everyone, welcome back to RT Invest. This is the second episode on the channel, and today we're going to look at the RT Invest copy portfolio. I'm going to be explaining to you exactly how I have constructed the portfolio, why am I investing the way I do, and also just for you to get a better understanding of the portfolio. If you or just before you decide to copy me on eToro. You have to understand what you are investing into. One of the biggest mistakes that you can do is to blindly invest into something that you don't understand. It's also a rule of investing is to always put your money into something that you understand, because if you don't do that, you are basically gambling, and you don't want to be gambling with your hard-earned money. The goal is to put your money to work, so that they can go out and even make you some more money. It just takes off the burden of you. Like for me personally, we are on the fire journey, and so for me every dollar is I don't want to spend the potential of that dollar. I don't want to waste the potential of that dollar. I don't want it to be losing value. I want it to be out working for me, earning more dollars, so that one day I can stop laboring for dollars. Anyways, that's a video for a different day. But for today, the RT Invest copy portfolio is designed for you to dollar cost average into the market. Now, I will also make a video on what exactly the dollar cost averaging strategy is. It works in some cases, and also it doesn't work in other cases, and there are different rules that applies to when you should be using the dollar cost averaging strategy and when not. But we're going to be talking today in the sense where you should be using it, and that is if you are investing monthly into the markets, or weekly into the markets. If you don't have like a big chunk of money, if you only have, like, let's say a few dollars every month or every week to invest, this is a very good strategy. So I've designed the RT Invest copy portfolio in order for myself to dollar cost average into the markets more easily. Because if I have to go on my personal account on eToro and then open up all the trades every month, it would be pretty time consuming. So what I've done is I've created the RT Invest, so then I dollar cost average into the whole RT Invest copy portfolio every month from my wife's account, or weekly from my wife's account, and then monthly on my own account, my own personal account on eToro. So it just it's just easy, because I set up the recurring deposit, and I just go and I just add funds to the RT Invest copy portfolio, and I click on the copy open trades checkbox. So I've made a video. Episode 1 is actually exactly on this. It is how to dollar cost average into the RT Invest copy portfolio. But for the purpose of this video, let's look at what exactly is the RT Invest copy portfolio. All right, so I'm going to be moving my video just out of the way. All right, so this is my homepage on eToro. So I'm going to be clicking on the RT Investing on my logo, and it's going to take me to my feed. You can see on the screen you have your feed stats portfolio chart. Now you can I'll first be explaining the breakdown, and then I'll look at the actual investments. So you'll see that my pinned post, describes exactly what, we are invested into. Now you can see that I have divided this portfolio to be 40% invested into pure US stocks, and also, growth. So 15% goes into the VTI. Now this is the total stock index of the whole US stock market. Now there's a few, I think there's like 3,700 or something stocks in this one ETF. So you can see that a big portion of this is invested, a big portion of the RT Invest copy portfolio is invested in US stocks. Then 15% is in the VOO. Now this is the S&P 500. It tracks the S&P. So it's basically the 500 and I think 3 or something stocks that are in the S&P 500 index. So it tracks those. And then the QQQ is basically your NASDAQ. So we've got 5% going in there. So it's the NASDAQ. I think it's a tech sector. The top 100 companies, the top 100 tech companies in the USA. And then also we have VOOC, which is the VOO growth stocks. So these are the stocks picked out by Vanguard. It's a Vanguard ETF. And so, these, they manage the fund. It's not an actively managed ETF. It's an passively managed ETF, but it only contains growth companies, that is also part of the S&P 500. You can see that's why you've got the VOO in there. So in total, we have 40% invested in the American markets. Then we also have a 20% exposure into the international markets. Now you can see that this is intentionally excluding the USA. So you can see we have the FWO. Now this is companies like Brazil, China, South America, South Africa. These are all emerging market countries, or companies that are based in the emerging markets. So we've got a 5% exposure there. Not too much, because it is quite risky investing into those countries, but they also pose a very good, or they also have or offer you the opportunity of big growth, because a lot of times developed countries often have less growth potential, whereas emerging markets often have a lot more growth potential, but also they have a lot of risk, that it can just as easily go the other way. So that's why we only invest 5% there. Then we have the exposure to the European countries, 5% there. We have 5% exposure to EWY. Now this is my Asian country experience. For those of you who don't know, I live in South Korea. So I've got there's no other country in Asia that I would want so much exposure into. I love this nation, and I really see them going. They're just going from strength to strength. So we've got a 5% into the South Korean market, and also if you look at the GDP numbers, their economy is massive. It's a massive economy. So this is definitely an economy that I want to invest into on a regular basis as they grow. This is a country racing to the future. I can just living here, just day to day, just shows you how these people are racing to the future. All right, then we have VXUS. Now this is also this is an ETF managed by Vanguard that invest in top companies around the world, no specific preference, but it's everything excluding the US. So there's no US based company in this ETF. All right, then we also have 10% into speculative or future value markets. So I'm investing in 5% into TAN. Now TAN is an ETF that tracks clean energy, green energy, solar energy, companies that are invested into just the whole drive of saving the earth, just being more green. I think that this is definitely an industry that's going to boom in the future. So that's why we definitely want to have it a part of our portfolio. And then also we have ARKQ. Now ARKQ is the autonomous. It's managed by ARK Invest. ARK Invest. I love ARK Invest. This is an ETF managed by them, and this is specifically focused on the autonomous vehicles. And I also believe that the EV and the autonomous vehicle industry is something that's going to really grow in the future. And so we definitely want to have exposure to that. I want to try something. I want to see if maybe it'll help if you see my face. Yes. All right. Then also we have crypto exposure. We want to have so there's a lot that I can say about crypto, and I'll make future videos on that, but we definitely want to have crypto exposure in our long-term investment portfolio. So we have 5% or 10% in total. but we have 5% in Bitcoin, 2.5 in Ethereum, 2.5 in ADA. Now, I made this as a tough decision. I know there's a lot of cryptocurrencies that would be worthy of adding to this portfolio, and I am open to that. I actually want to diversify a little bit more. I actually want to up this to maybe 15% and make some changes to the portfolio, because there's definitely a few others like Solana that I would want to add to this portfolio, and I have my reasons for that. But for now, this is what the portfolio has, and it's got a 10% exposure to crypto. Then we have the industrial and commodity sector. So, we have 10% into that. So GDX, that's our exposure to gold. So it's companies around the world that produces gold. I think, I don't think they do silver. I think there might be a small exposure to companies in the silver industry, but it's mostly gold. So that's our exposure there as a hedge. We also have exposure to XLE. Now that's the energy sector. It's companies like ExxonMobil. So you definitely want to have, especially, these companies have been beaten down, especially your XOP, which is the oil industry, with the pandemic. So there's definitely, they've taken a hit, but as the economy starts to open up, we will see, a gradual increase in this sector as well. So yeah, that's our exposure there. And then also we have exposure to the dividend and real estate market. Now, a part of this portfolio is focused on on earning dividends. Now the Charles Schwab, the SCHD, which is the Charles Schwab high dividend. It stands for high dividend ETF. Is a ETF that is constructed with high paying, consistently high paying dividend companies, and also we have exposure to VNQ, which is the real estate portfolio, and also the dividend returns on VNQ. So I have VNQ here for two reasons. Well, actually a lot, but I can make a whole video on that. But VNQ, basically you have a very high dividend yield on the ETF, and also it gives you exposure to the real estate market, just to diversify a little bit more. So as you can see, this portfolio is quite broad, and so you would always have, and it's also designed to be kind of hedged. So if one sector goes down, so if we have a drop, for instance, in the US growth stocks, which I think is imminent, we are now at late 2021. If you're watching this video, it's late 2021. I foresee a market crash coming soon. So this portfolio should theoretically hedge. So let's say there's a big market crash, there's a lots of fear, let's say because of inflation in the USA, a lot of strong inflation, so people might be flocking to more safer assets to safeguard their dollars. So they might be pouring their money into Bitcoin or into gold, or to so it's always, I can really talk a lot about how it is hedged. But I think if you have any sense of in investing, or if you have been in the market for a while, you would see that this is designed to always to kind of like to have a consistent growth. You don't want so this is not a portfolio that is aiming to achieve like 40% plus returns a year. This is a portfolio that is designed for growth, slow growth, consistently over the next 10 or 20 years. And obviously I'll make changes. This is the 2021 version of it. You always want to be on top of the game. You need to reassess. I would say bi-yearly maybe. And then just be consistent. Investing is being consistent. It's consistently investing into the markets, and never sell. You never sell. You don't want to be taking profits because you want to limit your tax obligations. So because as soon as you sell, you trigger a tax event, and you don't want to be paying taxes unnecessarily. This video is a little bit long. I'm sorry about that. I hope it makes sense. I hope that this video helps. If you are new, if you don't know about eToro, if you don't know how to sign up, you can find the sign up link in the description down below. It is an affiliate link. You will be helping out the channel if you click on that, but also it would enable you to invest into your own future. And yes, so thank you for watching. Thank you so much for the support. And yeah, if there's any suggestions or any comments, please feel free to comment down below, and I'll try my best to get back to you guys. And yeah, I hope to see you guys in the next video. Have a nice week and a nice day. Goodbye.